The world economy is failing, inflation is skyrocketing, and stock prices are falling. The macro situation is declining, and it's safe to say that things are looking bleak. Do you hear that? I hear birds chirping and coins clicking because all we hear are that stocks are trading at a major discount. Even if there are uncertainties in the market, there's always a rainbow at the end of the storm, and you can take advantage of this. Today, we're specifically going to be talking about dividend stocks. As we've said, stocks have been on discount and the S&P 500 has been down 21%, which also means that most of the stocks are currently down and at a discount. The question is, which ones are worth investing in? If you like this video, please consider kindly destroying the like and subscribe buttons because we are fairly certain you will not regret it. We research a lot of companies and share our best stock ideas so you don't have to. Make sure you watch all the way through because you don't want to miss our last pick, which is our favorite dividend stock pick for today. The first stock on our list is Comcast. Comcast is one of the most widely known entertainment platforms out there. Comcast is a media, entertainment, and communications company. Its business units include cable communications, NBC Universal, and Sky, a leading entertainment company in Europe that provides video, high-speed internet, voice, and wireless phone services directly to consumers. Comcast was trading around $35 per share during the pandemic. The stock climbed over 75% to just over $60 per share. Now, the stock is currently trading around $32 per share, which is actually lower than it was during the pandemic. Comcast had a total revenue of $116 billion in 2021, resulting in a 12.4% year-over-year increase, or an increase of $12.8 billion compared to the company's 2020 results. In top stocks, we believe that every number has a story, so why the 12% increase? Well, we looked into Comcast segments. We found out that the company had a $4.3 billion growth in its cable communication segment, leading to its excellent year-over-year performance. While the company may be doing good on an annual basis, the quarterly performance isn't looking too optimistic, with Comcast being down 1.5% on its third quarter results for the fiscal year 2022, since the company had a decline on its Sky and NBC Universal segment, causing its revenue performance to decline for a bit. What's impressive about Comcast, though, is that despite the high amount of competition, especially in the entertainment industry, the company still manages to keep its operating margin, which is slightly above the industry average. They've maintained an average of 32% operating margin for the past decade. This means that management is working on reducing costs to ensure they meet the threshold of having a pretty good operating margin, which is what you want to see when investing in companies. Pretty cool, right? Comcast also has a return on total capital of 8.7% in the past 10 years, which means that the company has generated a total of 8.7% returns from the company's capital structure. To understand why we picked Comcast as a great dividend stock, the company has had 14 consecutive dividend increases. Fast dividend growth is possible through solid earning performances. Its safety isn't questioned since it's well covered by the company's earnings and cash flows. Overall, we like the stock and have sufficient reason to support our beliefs. And with our current valuations, we expect the stock to have a 24.6% annual return. Wanna buy the stock? You decide for yourself, and who knows, you might find great potential in doing that. All we know is that the numbers don't lie, and it's looking like a buy to me. Moving on to the next stock on our list, we have Pfizer, with a current share price of $47. Since the world went through the pandemic, we have probably heard about one of the well-known vaccine providers for COVID-19. Pfizer is a global pharmaceutical company focusing on prescription drugs and vaccines. They're in the pharmaceutical industry where they specialize in vaccines and research on medicines through having better efficacy on vaccines. We think Pfizer is a good dividend stock because of the company's financial statements. In 2021, the company had $81.2 billion in revenue, or a whopping 95% year-over-year growth. While it's true that most of it came from pandemic vaccines, the trend doesn't stop there. The company reported $27.7 billion in its second quarter results, or a 46% revenue growth year-over-year. Pfizer is also able to maintain its operating margin of 46% over the past 10 years, which means that the company has enough earnings and cash flow to cover its dividend payments. I mean, when there are diseases and viruses, we need medicines and vaccines, right? In a world where there are always new diseases that need cures, Pfizer's a profitable business that capitalizes on the world's needs. Looking at the company's financials, Pfizer has a good return on total capital of 11.4%, which they have maintained for over a decade. The company has had a consistent dividend growth of 13 years, and with our current valuations, we expect the stock to have an annual return of 8.5%, which, well, it isn't the highest return, but hey, it's still a good company. The following stock we'll discuss is similar to Pfizer, and it's Baxter International, which is currently priced at $55. Like Pfizer, Baxter International develops and sells various healthcare products, including biological products, medical devices, connected care services, devices, and equipment used to monitor patients. They're some of the equipment that you would typically see in hospitals. Their products are used in hospitals, kidney dialysis centers, nursing homes, doctors' offices, and patients at home under physician supervision. Think about it. What's better than a profitable business in creating equipment that could save a person's life? Baxter International is the one. Moving on to the financials, the company generated $12.7 billion in revenue in 2021 with a 9.5% year-over-year growth. Again, similar to Pfizer, this could be because of the equipment needed to be purchased during COVID-19 lockdowns when hospitals were filled with patients needing monitoring equipment. Baxter International also has maintained its above-average operating margins of 22.6%, which means that they managed to keep operating expenses low and maintain the amount of money the company gets to keep. They also held a relatively good average return on total capital of 12%. However, Baxter International's return on total capital in 2021 declined to 7.4%. From a broad perspective, they did a great job of maintaining a double-digit return on total capital. So, why is it a good dividend stock? Baxter International has a 6-year dividend growth streak and has been paying its shareholders for 32 consecutive years. This can be backed up by the company's ability to generate money from earnings and cash, which covers the dividend payments. With our current valuation and the company paying consistent dividends, we expect the stock to have an annual return of 17.3%, which is excellent considering that it's currently priced at $56. Overall, we like the idea of the stock, and its consistency adds a sense of safety to investing it as a dividend stock with great returns. For the following dividend stock on our list, you probably have heard about them before, and that's the 3M company, which is currently priced at $127. 3M sells more than 60,000 products used daily in homes, hospitals, office buildings, and schools worldwide. It has about 95,000 employees and serves customers in more than 200 countries. 3M is composed of 4 separate segments. The Safety and Industrial Division produces tapes, abrasives, adhesives, supply chain management software, and manufactures personal protective gear and security products. You probably got a few tools lying around your house with a 3M logo on them. So if you do so, then that's the company we're talking about. The healthcare segment supplies medical and surgical products and drug delivery systems. The transportation and electronics segment produces fibers and circuits to use renewable energy while reducing costs. The consumer division sells office supplies, home improvement products, protective materials, and stationery supplies. So you may be thinking, you said that inflation isn't going down. consumer spending patterns change and markets are down, right? Would a 3M be a bad company solely because they rely on consumer spending patterns? Because prices are higher. The company is also facing litigation issues affecting its reputation and revenue share. However, we still like this stock, so stay tuned to learn more about the company. 3M Company achieved $35.35 billion in revenues in 2021, a 9.9% year-over-year growth compared to the company's 2020 performance, which was led by the company's safety and industrial segment of $12.8 billion in revenues. The company also has relatively high operating margins of 26% in 2021 and a 10-year average of 27.5%, which the company has successfully maintained over the years. Similarly, the company also maintained a 22% return on total capital, which screams consistency to me. However, our highlight for 3M is its dividend growth. The company is raising its quarterly dividend from 0.7% to $1.49, extends the company's dividend growth streak of, hold on, wait for it, 64 years. Talk about consistency. The company's dividend growth streak has been going on for 64 years, and boy, do we find this astonishing with 3M Company. Although dividend growth has outpaced earnings growth in the past years, we don't feel the dividend is in danger of being cut. A recession could slow down the growth, but hey, if you're investing in dividends, then you're probably in it for the long run. And with our current valuations, we estimate the company to generate a 17.3% annual return, so we leave this decision to you. Think about the 64 dividend growth streak. For the last but definitely not the least stock on our list, we have Verizon, which is currently priced at $38. Verizon is a well-known telecommunications brand, and you probably have a Verizon plan on your phone right now. Wait, you don't? Well, that's okay because you don't need a Verizon data plan to invest in them. To give a little background, Verizon is one of the largest wireless carriers in the world, which covers over 300 million people and has rolled out most of its 5G ultra-wideband in several cities. Verizon's stock price was $54 when COVID started and has been down spiraling ever since then. To ordinary people, this may seem wrong, but to us, it's a massive bag on a discount. Talk about bang for the buck. Now you're probably wondering why we're so positive with the stock declining so fast. As we all know, all markets are down and inflation isn't going down. Here's our take on Verizon and why we think it's a great pick. We think that Verizon's ability to increase its revenue while keeping its large margins drives the company's success. Revenue from Verizon's consumer segment grew 9.1% to $25 billion, driven by one of its subsidiaries, TracFone, a mobile virtual network operator or MVNO. Verizon's average revenue per account grew by 2.4% and wireless revenue by 9.1%. The company recorded $133.6 billion in revenues in 2021, which is a 4.1% year-over-year growth. It may not seem much, but considering Verizon's size, we think it's a reasonable revenue growth. With the company rolling out 5G services, it can potentially have more significant growth considering that they already are one of the largest wireless carriers in the US. It has maintained an average operating margin of 21%, which is above average and acceptable in the communications industry. The company also has an 11% return on total capital, which means it generated an 11% return through its capital structure. The company paid $2.02 dividends back in 2012, which increased by 54 cents since the company paid $2.56 in 2022. The stock is currently priced at $35 today, and with our valuations, we expect 26.9% annual returns from Verizon. Additionally, the company has been increasing its dividend payments from 17 consecutive years. Similar to the other stocks we have on this list, Verizon also practices consistency, which is very important in dividend stocks. Overall, we think that Verizon is a good dividend stock, and through our analysis, it's a good investment in the long run, which is why it's definitely our favorite stock. Hey, if you made it here, thank you so much for watching the video. We appreciate your time. That wraps up our 5 best dividend stocks to buy now, and if you enjoyed the video, make sure to kindly destroy the like and subscribe button. Let us know in the comment section what your favorite stock is, and peace out!